Welcome to the Retirement Architect with David Reyes. Our program is designed to not only provide insight, but to educate and give you the tools you need to design and build a rock-solid retirement.
Here with the Retirement Architect, David Reyes from Reyes Financial Architecture, and we have been reviewing over the course of the past couple episodes here the Are You Ready to Retire checklist, a helpful checklist of 12 must-answer questions for retirement confidence. David, we're going to continue on with that discussion. Number 9 on the list, do you know the cash flow rate your portfolio will need to generate in order to meet your retirement needs? Now, I know that the acceptable cash flow rate that a portfolio should be able to generate has been subject for much debate over the past 20 or more years.
Yeah, there's an old thing called the 4% rule, which was actually created by an advisor back in the 90s when stocks were averaging 20 and bonds were averaging 5. So that's pretty good. And think about that. So if you have a blended return of like 15% and you only
get a double-digit savings rate.
It's kind of crazy. So, I mean, those numbers, we look at things on an absolute basis. I'll tell you from experience, a client needs about 5% distribution rate, okay, and cash flow, right? So that's where the terminology gets a little crazy. Right. We talk about this Monte Carlo simulations. What's that? It's a random number generation. And here's how much I can take from my portfolio, regardless of growth over the next 30 years. What we look at is we want cash flow, right? So I can tell you that which is a tall order. We do this every day, though, is that we shoot for 5% cash flow. So again, using the rental property analogy, if I have $1 million rental property, I want to be able to produce $50,000 a year of cash flow and still have my house, right? So that's how we start, is that's what we want everything. We want to have the cash flow. We want to have the asset grow, all those things to ensure we don't run out of money. So I will tell you, because I know this pretty cold, is that the average boomer portfolio, we call it, the 60-40 stock and bond portfolio has a yield of about 1.5%, right? A little, maybe closer to 2 now because rates are a little bit higher. Let's call it even 2. Problem is after taxes, all those kind of things. I mean, you're talking about a net cash flow of, let's call it 1.5% or 1. But the fact is, even using 2% on $1 million, that's $20,000 a year. I'm already telling you that the average client needs 4 to 5% distribution rate without spending down all their assets. And so that's about twice. Morningstar, which calculates this every few years, I think their latest number was like 2.9%, 2.8%. Of what you could take out safely. So with inflation running the way it is today, now I don't think it's going to stay at this level, but so what? I think we're going to have more persistent inflation that maybe is in the 3 or 4%, which is a big difference from 0 to 1 to 2%. So we need, I would tell you, around about a 4 to 5% distribution rate to be able to deal with taxes, inflation, and most clients' portfolios are going to produce cash flow between 1 to 2%.
Now, David, have the increasing interest rates that we've seen over 2022 and continuing here, I know they had a lot of adverse effects on different aspects of the market and the economy, and certainly financing, but has it improved the outlook for the cash flow that a retirement portfolio can generate?
Yeah, that's a tricky one. Actually, I was talking to a client about that the other day. I would say tactically it does. What happens when inflation goes down again, which is great, but what happens to bond prices? They go down. So right now, like I haven't done a bond ladder in 20 years, right? We've been building treasury bond ladders this year for the first time, really in the last 6 months, 3 months, because now we can get between 1 to 3 year treasury bonds, which are guaranteed by the federal government, between 4 to 4.5%, right? But here's the reality, is that as rates come back down again, what's going to happen to those yields? They go down. So I think we can use those in the short term, but I don't think it would be disingenuous for an advisor, in my opinion, to say, okay, we can get 4% from our bonds for the next 30 years. Probably not going to happen. Okay, i.e., a 30-year treasury bond's trading in the 3% range, right? Not in the 4% range. And those yields are actually coming down now pretty hard, about almost 1% just in the last, as of this recording, in the last month. So we can't use that as a long-term vehicle for our planning for retirement, in my humble opinion. That's not an asset class I can count on, because, like, look at this year, the bond market has been down 10, 20, 30%, right? Because rates have been rising. So right now it's kind of a Goldilocks period. where I think it's not a bad idea to own short-term treasuries, and even long-term treasuries you can own. But as a pure cash flow vehicle going forward, I think it's going to still be a challenge, especially if we have disinflation and rates do fall. The yield on the bond portfolio will fall as well.
Now, of course, this checklist is important reminders, a list of different topics that we must address in order to be prepared for retirement, to be confident throughout retirement. So, David, I have to imagine that the majority of people yet to be retired conversations that you have not actually sat down and really examined the cash flow rate that their portfolio can generate.
No. At a minimum, what they've done is said, here's what this program said I could take out based upon the growth of the stock and bond market, which we can't control. But I haven't had one client ever come to me ever in almost 30 years that said, here's how much income can be generated from my portfolio. Because like I gave you the example of the boomer portfolio, which 90% of clients that come to see me, prospective clients, have in their 401k plans, 60% stock, 40% bonds. That portfolio, which has been down over 20% this year, also produces less than 2% cash flow. So it doesn't really matter. The cash is being generated from their portfolios because they've never considered this before. How do they know how to invest their capital if it's changed from growing my money to producing income? So they just don't have the experience to do it. So it's no fault of their own. But my advice, you better find somebody who does, for sure.
Related to this, although slightly different, do you know the percent of your working income you will need to replace to support your lifestyle in retirement? And I think that there is a false conception about the fact that retirement is somehow magically going to be significantly less expensive, or that we're not going to pay as much in taxes. There are myths or misunderstandings that we will not need as much income in retirement.
No, we need the same amount of income. With my clients, I'm trying to replace their paycheck 100%. That's what I'm trying to do. And I'm saying the net paycheck, not they're making $200,000 a year. I'm not going to replace $200,000 a year, but that person who's making $200,000 a year may be netting $10,000 a month of income, right? That's the bogey. That's what we're trying to shoot for. And that's where we start. We want to start with what's possible, not with what's minimally required. Because if clients, most of my clients, their number one thing is they want to go visit and play with their grandkids and their kids.
Yeah,
right.
I was going to say, David, like, to me, retirement every day is a Saturday on vacation. And I know that I either am at work earning money or out there in the world spending it. And I tend to spend a whole lot more on Saturdays and on vacation. And I also think back 20 years, and I know that things were significantly less expensive then. So if I flash forward in time 10 or 20 years, I would expect that things are significantly more expensive into the future.
Oh yeah, I mean, it is. So we want to plan. Retirement plan is not planning for my expenses; it's planning for a lifestyle, and we take that very seriously, right? And I'll tell you, the probably the favorite part of my job is people, the smile on their face when they realize how much more they could probably spend than they thought they could. And that's a pretty common occurrence, is most of my clients are probably able to spend 20-30% more money in retirement than they would have on their own. So that's the most pleasing for me selfishly, because that's a quality of life that we're able to help them for the rest of their lives that they wouldn't have done on their own. Because unfortunately, most of us have a scarcity mentality. We have a pie that's only so big. And if we take a piece of that pie, we have less pie, right? And so quite frankly, if we can show a client how we can produce cash flow from that pie, so to speak, and not have to sell those pieces of pie like they were going to do on their own, we probably can have more money and more pie down the road. So that's what we want to do.
Unfortunately, there's somebody else that's taken pieces of our pie as well, number 11 on this list. And again, by the way, ladies and gentlemen, if you'd like this list to go over these 12 questions on your own, just give a call to Reyes Financial Architecture, 858-597-1966. But the IRS, the tax man cometh. Yeah. Do you understand how much you will be paying in taxes in retirement, how much of your pie Uncle Sam is going to take, and how much of your retirement account withdrawals you'll actually get to keep and spend? A lot of people have gross planning mistake. They're planning for retirement based on gross numbers, not the net numbers like you're talking about, David.
Exactly. Again, if I was just putting my finger in the air, our average client's going to pay about 20% in taxes on an effective tax rate, meaning that what they actually pay in taxes, not on the brackets. So the reality is that taxes for most clients are not going to make or break their retirement. Now, making smart decisions about selling real estate or selling certain investments, those are the bigger impacts in most cases, right? But you can take a simply, if somebody needs, $10,000 a month in income, right? We need to gross that up by 20%, right? So we have to be careful saying, okay, I need 10,000 a month. Well, you probably need about 12,000 a month in gross income. Now that's 144,000 a year. Right. So it starts getting more challenging as you start moving up the number. So I don't want to minimize the impact at all. But the fact is, on a dollar for dollar basis, clients are they're not going to have lower taxes in retirement. Theoretically, they're probably going to pay about the same amount of taxes. We're going to say, here's the net paycheck that goes into your checking account every month. We custody with Charles Schwab. It's real simple. Our clients, they hire us. We put their portfolio together. Every month they get a check for $10,000 a month, from Charles Schwab to their bank account, ACH every month. So we're replacing the paycheck literally every month. So yes, you want to be precise not only on the investment side, but also making sure we're optimizing the taxes. The biggest opportunities happen around there is on the taxable accounts. That's where you control the taxes more. The brokerage accounts, trust accounts. On the retirement side, on the IRA 401k side, you're going to pay ordinary income tax, right? So there's not a lot of tax management on there. Where we earn our keep on the tax planning side is somebody selling a piece of real estate, selling a business. If we have a lot of money in after-tax money, there's lots of opportunity to control the taxes on those types of events.
Bringing this all together, number 12 on the list. Do you have a retirement blueprint with the income plan in writing? And I think that throughout the course of our conversation on these 12 questions, you've said a lot of people have projections, but don't really have that blueprint plan in writing.
Well, yeah, I mean, think of the, again, just myself personally spending 3 decades doing this. I mean, we give written plans to every client. So it's not just about the Social Security, about, the spreadsheets and all. It's just, do you have the experience and the confidence, right? I think the biggest thing that we help clients with specifically is being confident and saying, hey, we've done this for a long time. Here's how we would do things. And it's kind of like going to the doctor, right? You don't want the doctor that, here's my first time I've done surgery. You know what I mean? I hope it goes okay. Right. So, you want to hopefully work with somebody, whether it's our firm or somebody else that has deep experience on this and puts everything you do in writing. So every one of our clients that goes through our process, whether they hire us or not, they get a full written retirement income plan from our firm. And that's something you have to have for sure.
Once again, if you would like this list of the 12 questions to know, are you ready to retire? These 12 must-answer questions for financial and lifestyle confidence into and throughout retirement. Pick up the phone and give Reyes Financial Architecture a call, 858-597-1966. And if you would like to construct your retirement blueprint, the written retirement income plan, if you have $1 million or more in investable assets, you can meet with David, the retirement architect, personally. Pick up the phone and give a call, 858-597-1966. That's 858-597-1966. You can also visit online. Lots of fantastic additional information, resources available at reyesplan.com. That's REYES plan.com, reyesplan.com. But again, the true value is the application of knowledge. Good information here on the program, but if you've got $1 million or more in investable assets saved for yourself to support your retirement, pick up the phone now. Make sure you've got that retirement blueprint, or double check and evaluate your current plan for retirement. 858-597-1966. David, always a great conversation, always important information. Thank you for being here as that resource.
Thank you. I appreciate it.
Thank you for spending your time with us again this week. Get the most out of your retirement plan. Call 866-REYES-PLAN. That's 866-REYES-PLAN. 866-739-3775. Or visit reyesplan.com.
No information presented today should be acted upon without meeting with a qualified and licensed professional. Reyes Financial Architecture, Inc., RFA, is an SEC-registered investment advisory firm. Such registration does not imply a certain level of skill or training. For a copy of RFA's current Form ADV 2A brochure that includes a description of services provided, fees charged, and other important information, call 858-597-1966 or go to advisorinfo.sec.gov. RFA also is a licensed insurance agency with the state of California. License number 0G66604. This show is provided for informational purposes only. Opinions expressed in the show reflect RFA views as of the date of the recording and are subject to change. Nothing should be construed as a comprehensive statement of the matters discussed, considered investment, financial, legal, or tax advice, or a recommendation to buy or sell any type of security, and no investment decision should be made based solely on any information provided. Any forward-looking statements or forecasts discussed are based on assumptions, and actual results can vary from any such statements. Some of the information provided has been obtained by third parties and believed to be reliable, but not guaranteed. Past performance is not an indication of future returns. With respect to any discussion about RFA investment strategies, there's no guarantee that they will be profitable or perform as described during the show. RFA or one or more of its employees may have a position in the securities discussed and may purchase or sell such securities from time to time. All investments in securities carry risk, including the risk of losing principal amount invested. Different types of investments involve varying degrees of risk. There can be no assurance that any specific investment or investment product will be profitable or suitable for a particular investor's financial situation or risk tolerance. Asset allocation and portfolio diversification cannot ensure or guarantee better performance and cannot eliminate the risk of investment losses. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing insurance company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Surrender charges apply to base contracts. Optional life income benefit riders are used to calculate lifetime income payments only and are not available for cash surrender or in a death benefit. Fees may apply. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Rates and returns mentioned on this program are subject to change without notice.